Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Pete Cahill, one of our senior portfolio managers. Pete, we talk a lot internally about behavioral finance, and there's a lot of articles to read. And in fact, one of our favorite books is Psychology of Money by Morgan Housel right now that talks about behavioral finance and the decisions we make. Can you explain to our clients the importance of behavioral finance and why we include it as one of our core tenets of our investment philosophy?
Yeah, I'd be happy to. It's great that there are so many books being published about behavioral finance. Behavioral finance is a field of study that seeks to understand the interaction between our mental biases and our decision making as it relates to money matters. Behavioral finance is relatively new, and it arises from some controversial assumptions that have been made by economists and economic theory. For the past 100 years or so, economists have built economic models, and one of the underlying assumptions had been that human beings were something they referred to as rational beings. To say that differently, they thought all humans were at all times robotic and without emotion. Life has taught us nothing else. It's taught us about the human experience. And while it's great to have those emotions of being human, they don't work so well with investment decision making. So what I'd like to show is some of the key concepts on this graph of behavioral finance. And I'd like to focus on just two of them. The first being loss aversion. Loss aversion is a topic we covered at length in our Outlook piece last year. It basically uncovers that losing is more painful than winning. And losing money on investments can be very painful. And that pain can cause us to make decisions that aren't in our best interest. Another topic I'd like to talk about for a second is recency bias. And that's with everything coming at us in the world this day, seemingly by the minute. We at times place too much emphasis on the here and now when making decisions, and not enough emphasis where we discount history. So behavioral finance, it's very, very important, and it's something we spend a great deal of time thinking about.
Well, obviously it's important. This is the second year in a row that we've asked you to write about it in the annual Outlook piece. So let's delve a little bit deeper into recency bias because, like you said, there is so much news coming at us, and that does set up how we think about investing.
Yeah, so one of the central foundational parts of our investment process is the path to financial success is focusing on the long term. And that's a very commonsensical approach. Focus on the long term. Makes logical sense. In the real world, it's a challenge. There's new technologies, there's breakthrough drugs, there's fads that everybody are talking about, there's armed conflicts and pandemics and things that bring the here and now to the forefront almost solely to our decision making, or want us to. Recency bias tends to encourage us to want to chase investments at the top. It tends to encourage us to panic sell at the bottom. And our experience suggests that that's one of the most costly mistakes an investor can make. So where did this recency bias come from? Well, it came from here, how our brains are wired. See, for thousands of years, our ancestors, when they woke up in the morning, they had one objective throughout the day: avoid danger and find food. And that encouraged a decision-making process that was quick. There wasn't much time. So that was fine-tuned over thousands and thousands of years. A few hundred years ago, financial markets came to be. That's a tiny blip in the time span of human history. Financial markets, to navigate them correctly, require deliberate thought and thorough research. So when you think about it, tens of thousands of years of evolution of our ancestors making quick decisions and being rewarded. Financial markets, shorter period of time, required a different method of thinking. There are times where the recency bias causes us to make decisions that ultimately will hurt us. So you might be saying at this point, well, are we all destined to fall prey to the recency bias? We don't think so, but we do think it requires a toolkit, if you will, which is displayed here on this graph. First, We need that kit to have a sound financial plan. We need the tools to be diversified. We need maybe a library book. We need a structure in place that we can hold to account. So probably the most important tool in avoiding the recency bias is just giving yourself permission to turn off the noise. If you're feeling a desire that you have to have it right now, be it a stock or a type of investment, or if you're very fearful about economic times, turn the TV off. Give yourself permission to do that. Put the cell phone down, put the newspaper down, pick up an old book instead. Listen to some music, spend time with a loved one. That can help you avoid the recency bias. You know, there was a founder of behavioral finance that used to like to say, seldom are things right now as important as they really are. So behavioral finance is something, as you probably can tell, is very near and dear to my heart, and I appreciate the time being able to talk about it.
Well, I know you've been studying this much longer than most of the team, and so I do appreciate your thoughts on behavioral finance and obviously the recency bias. There's a lot of data coming at us all the time. If this is your first time watching the market share, I encourage you to subscribe at firstsource.com so you continue to receive our information. And if you like today's video, please share it with your friends, family, or colleagues. And as always, thank you for the opportunity to serve you and your family, and have a great holiday season.